Hello, I'm Noelle Lim on ASEAN Speaks by Maybank Investment Banking Group. As always, on Mondays, our analysts present their key research to prepare you for the week. They discuss economic data, the ringgit following a sharp sell-off last week, market strategy in light of rising interest rate pressure and the property sector, ending off with our first comprehensive sustainability report. This one is on regional utilities. Taking it from here is Chua Hak, Regional Co-Head of Macro Research.
Quick recap of last week. Global equities ended the week in a spectacular sea of red with mixed earnings results and more hawkish remarks on aggressive interest rate increases. The MSCI World Index fell 2.7% on the week, the third weekly decline. The S&P fell by almost 3%, while the Nasdaq fell by about 4%. Netflix share price crashed almost 40% after it said that it had lost customers expected to lose more. The US dollar surged to a two-year high, which took a toll on the yen, especially. Even the renminbi, which has been relatively steady, slid sharply against the dollar last week, 1.5% down. That's the biggest move in 3 years. The Stoxx 600 fell 1.4% on the week. Asia wasn't spared. MSCI Asia Pacific Index ex-Japan fell 3.1% on the week, led by sharp falls in China and Hong Kong. ASEAN stocks were more resilient. Thailand, Singapore, Malaysia, Philippines actually end up slightly higher over the week on reopening optimism. Indonesia down slightly. Both Singapore and Thailand are relaxing and ending pre-departure tests for all vaccinated travelers. But Vietnam markets collapsed by 5.5% last week on news of corruption and string of arrests. Last week, Tri-Viet Securities CEO and Louis Holdings chairman were detained by the police, accused of allegedly manipulating stock prices. Vietnam Prime Minister Pham has ordered authorities to crack down on violations in the equities, bond, and property markets, sparking investigations which has hammered the stock market. With the sharp correction, Vietnam has become the worst performing asset market this year after the spectacular bull run last year. Fed Chair Powell suggested that Fed will be more aggressive and moving a little more quickly to combat inflation, which is running at the fastest in 40 years. This is probably the strongest signal that the Fed will hike by 50 basis points on 4th of May, less than 2 weeks away. Markets are now pricing in 50 basis point hike at the next 3 meetings in early May, mid-June, and late July. This is probably going to be the sharpest interest rate shock over a 3-month period since the early 1980s. The US 10-year bond yield gained 7 bps last week to 2.9%, the highest since December 2018. The 2-year 10-year bond yield spreads positive, not inverted, but has narrowed to 23 bps. Both the World Bank and IMF cut their global growth forecast last week, given concerns over the impact of the war and China's lockdowns. In particular, IMF slashed the China GDP forecast to 4.4%. That's well below the government's 5.5%. President Xi Jinping's speech failed to soothe market concerns. Both the Shanghai Composite and Hang Seng Index fell by about 4% last week. There's no signs that Shanghai's lockdown will be relaxed anytime soon. And just bear in mind there's a risk of a broadening lockdown in Beijing as infections have risen. Brent crude oil fell sharply 4.5% last week to about 106 on concerns over weaker China oil demand. The WCI Container Freight Index also fell about 1%. That's the 8th consecutive weekly decline. On the US macro data releases last week, the prelim April US Composite PMI fell to 3-month low of 55.1. Although service providers reported a softer uptick in activity, manufacturing firms noted the quickest upturn in production since last July. New orders eased from a 9-month high in March, but new export orders expanded sharply. The negative news is that the data also reported record increases in input costs. For this week, the key US data releases include the April Conference Board Consumer Index, new and pending home sales for March, prelim Q1 GDP, personal consumption, and core PCE. That's the Fed's preferred measure inflation. Bear in mind that the CPI headline inflation was 8.5% in March. Markets are forecasting 5.3% for the PCE. In Asia, watch out for the private sector, Caixin China Manufacturing PMI and official PMI. That's, I guess, in the coming weekend. That's probably going to show a deep contraction because of the lockdowns. Other notable events include the Bank of Japan monetary policy meeting, Taiwan and Korea prelim 1Q GDP, Singapore inflation March and unemployment rate, Thailand trade, and Vietnam's slew of April industrial production, CPI retail sales and trade data. There will be a flood of corporate earnings results this week, but the focus will probably be on the tech giants. So among those reporting this week include Apple, Alphabet, Boeing, BYD, Caterpillar, China Petroleum, CNOOC, Coca-Cola, Exxon, GE, Hong Kong Exchange, HSBC, Hyundai, ICBC, Intel, MasterCard, McDonald's, Meta Platforms, Microsoft, Nomura, PayPal, Ping An Insurance, Spotify, Twitter, UPS, Visa, as well as Singapore's two banks, DBS and UOB Bank. Just to update, just 2 hours ago, I guess Macron has won the French presidential elections, beating Le Pen for a second term, I think by a comfortable margin, 58% of the votes. Today, we have Suhaimi on Malaysia's export inflation data and a weak ringgit, Jue on the bank measure policy meeting, Chee Ting on the ban on the palm oil exports, Anand on his latest Malaysian equity strategist, report against a backdrop of rising interest rates, Mun Yi on the Malaysian corporate bond market, and why may be underpricing credit risk. And we have 3 property analysts, Wei Sam, Vanida, and Sevi on the property outlook in Malaysia, Thailand, and the Philippines. And finally, Jigar on his 122-page bullish report on ASEAN and India regional utilities on the shift towards renewables. So let's kick off with Suhaimi first. Suhaimi, Malaysia released export inflation data for March over the past week. Any key takeaways on the data?
Right, morning. Yeah, exports is still sustaining its double-digit growth momentum. In March, it grew 25% year-on-year, improving from February's 17% year-on-year. In first quarter, though, it expanded at a slightly lower double-digit pace of 22% against fourth quarter 2021's 29% growth. But I think the key takeaway is the fact that palm oil, LNG, and crude oil contributed to almost 1/3, and E&E contributed to another almost half of export growth in March and first quarter of this year, reflecting basically higher prices and volume growth. On inflation, headline inflation rate was unchanged at 2.2% year-on-year in March, the same as February. First quarter, it also averaged 2.2% compared with last year's 2.5% inflation rate. I think a key factor keeping inflation rate relatively low and stable against the trend we are seeing elsewhere around the world is the easing in transport inflation because of the continued fuel price subsidy. Food and beverage inflation rose for the 5th month in a row to reach 4% in March, compared with 1.9% in September, October last year. And nearly 80% of headline inflation in first quarter was driven by food, fuel, and utility, indicating a predominantly cost-push inflation amid the surge in commodity prices rather than a broad-based inflation. Core inflation in Malaysia up for the 6th month in a row, reaching 2% in March against 1.8% in February and the recent low of 0.6% in August, September last year. And for the first quarter of this year, core inflation rate is 1.7% versus 0.7% last year. And the trend in core inflation point to pent-up discretionary spending and services demand effect of economic opening, given the uptrends in costs for CPI components like restaurants and hotels, recreation, and spending on the likes of furniture, housing equipment, and routine household maintenance. So we are keeping our 2022 inflation rate forecast of 2.7%, but see upside risk from global commodity prices, supply chain risk and disruption in the wake of latest bout of China lockdown, implementation of minimum wage hike 1st May, as well as the depending on government decision on fuel subsidy review.
So I'm getting a lot of message on the Malaysian ringgit. The ringgit sold off sharply last week to 4.32 against the US dollar. And against the Sing, it's fallen to about 3.16. That's a 5-year high for the Sing dollar against ringgit. Is there a risk that the ringgit could face a sharper sell-off on the back of the aggressive impending Fed rate hikes while Bank Negara remains on hold?
Yeah, I think despite the supposed positive of ringgit from being Malaysia being a commodity exporter, given the high commodity price right now, I think ringgit came under pressures due to narrowing positive carry on interest rates against US, as per what you mentioned just now in terms of the speed of interest rate hikes between US and Malaysia. Then that resulted in foreign selling, notably in the bond market. But there's also the risk-off sentiment effect following IMF cuts in this year's global economic growth forecast. And bear in mind also we have the drag from weaker renminbi, where ringgit is strongly correlated with. As far as near-term outlook, I can only share with you what the charts are saying from a technical analysis perspective. Certainly, there's near-term weakness bias with ringgit dollar rate looking to test the resistance level of 434, despite US dollar being in overbought situation, which if broken may see ringgit dollar rate testing the next resistance of 438. And I guess there is a risk of it potentially reaching the pandemic period low of around 440 to 435 that we've seen in late March 2020. Having said that, our current forecast by our FX research team is ringgit reversing current weakness later this year to end 2022 at 415 as BNM starts raising interest rate from fourth quarter of this year, and the pace of interest rate hike to gather momentum in 2023.
Okay, thanks, Suhaimi. Let's bring in Jue. So Jue, Bank Indonesia decided to hold policy rates at a meeting last week. Any key takeaways from the briefing and signals on whether BI will hike rates anytime soon?
Good morning, everyone. So maybe perhaps three key takeaways from the policy meeting. Firstly, on GDP growth downgrades, BI cut its global GDP forecast to 3.5% from the previous 4.4% due to supply chain disruptions from the Russia-Ukraine war. For Indonesia's GDP, BI also downgraded its growth forecast for the first time this year to 4.5 to 5.3%. On the back of slower global growth and weaker domestic demand due to higher energy and food prices. Our forecast for Indonesia GDP still stands at 5.1% at the higher range of BI's new forecast. Secondly, on the current account, BI raised its 2022 expectation to a narrower deficit of 0.5 to 1.3% of GDP from the previous 1.1 to 1.9 on the back of higher commodity prices. Exports have jumped by 44% and rose to a record high in March as prices of key exports, including coal, palm oil, nickel, and steel surged following the Russia-Ukraine war. And the strong external balance has also supported the rupiah, which has outperformed other currencies in the region. Thirdly, on inflation and policy guidance, Governor Perry stated that inflation stays manageable and is expected to average within the 2 to 4% target range this year, while adding that BI will continue to monitor risks from higher global food and fuel prices. He emphasized again that the central bank's monetary policy response will depend on core inflation, which will capture the second round impact from any rise in prices. And BI will not react to the government's decision to raise prices on subsidized commodities. We are expecting BI to deliver its first 25 bips rate hike this quarter, which could be as early as the next meeting on the 24th of May, following the US Fed's anticipated 50 bips hike in early May. Our base case is for BI to raise the policy rate by 75 bips this year, but risks are on the upside if inflation comes above BI's target range because of a hike in subsidized fuel prices.
Okay, thanks, Jue. Chee Ting. So I think Indonesia surprised the markets and maybe the world with the ban on palm oil exports on Friday. So why such a drastic measure? I guess there'll be huge potential export revenue loss. And how long do you think it will last?
Hi, happy morning. Yes, indeed, Jokowi surprised the world with the ban. Well, the priority is to ensure they have sufficient supply of cooking oil in Indonesia itself. But really, this move was a surprise because we thought that they would have sufficient subsidized cooking oil given the efforts taken the last 2 months. But very little details were provided in his speech. But we understand, this could result in a surplus of nearly 30 million tons of CPO in the domestic markets because the production of CPO is around 48 million tons a year, whereas domestic consumption is only 18 million tons. So what we think will happen is that the storage tanks in Indonesia will be overflowing within 1 to 2 months if the export ban stays. And that would be negative for prices, especially in the domestic market. The domestic market prices should become lower and gravitate towards the Indonesia's subsidized cooking oil price, which is around 14,000 rupiahs per liter. Briefly, that would be meaning is about 15% lower than what Indonesia's domestic CPO price is today. But positively, in the international arena, we do expect the futures price or the international price to move up.
So, Chee Ting, who's going to be the big winners from this move or losers?
The biggest winner are obviously going to be Malaysian-centric planters. So pure Malaysian players include Sarawak Oil Palms, Ta'an Holdings, Balstad Plantations, and Hapseng Plantations. Among the large caps that we cover, IOI has the least exposure to Indonesia. Their production in Indonesia is just 7%, which means that 93% of the group's output is mainly coming from Malaysia. So these are the clear winners, but we do like to highlight that Indonesia's export ban is temporary.
Okay, thanks, Chee Ting. Anand, on your Malaysian strategy report, the rate pressures building. Why are these interest rate pressures building up, even though Bank Negara has not hiked policy rates? And what are the implications for the Malaysian market?
Yeah. Hey, good morning, Hak Bin, and good morning, everyone. So we wrote this report because we're getting a lot of questions from clients about whether an interest rate move may come faster than our base case 4Q 2022 OPR hike. On the surface, inflation numbers look very well behaved compared to what's happening in the US, etc. So March CPI numbers, as Suhaimi mentioned, about 2% on a headline basis. But if you look at the underlying issues facing Malaysia on the inflationary front, they are quite concerning. You have obviously you have this yield gap that is widening with the Fed as they aggressively tighten monetary policy. And you have the cost push stuff coming through from the commodities and supply chain issues. But you also have some Malaysia-specific stuff like minimum wage hike that's coming in from next month, and that's a big hike. That's a 25% increase in the minimum wage. And now you have this very sharper than expected weakening in the US dollar ringgit exchange rate. So if you look at domestic bond yields, they've shot back above 4%. And if you look at flows in the fixed income market as well, we are seeing outflows probably continuing from the big number of 4 billion outflows we saw in March. So you put it all together, it does seem that there is a lot of pressure to raise rates sooner. So in this report, what we did was we looked at our coverage and what it would mean for interest rates to go up by 100 basis points. And it is obviously, given that most of the companies on the KLSE are leveraged, it is a headwind. More so for some sectors like property and REITs, very leveraged operating models as compared to other sectors. But there are also some, sort of neutral to marginal positives. And you'll see that mostly in the petrochemical space, like someone like Petronas Chemicals is sitting on 14 billion net cash. That's going to be earning more returns when rates go up. And also the tech space, where pretty much everyone has a net cash balance sheet. So, it's not all losers from higher interest rates. We would also point out that banks are a big winner. So figure 5 here, you'll see the OPR sensitivity or earnings sensitivity to OPR hikes. And banks like Alliance and RHB, which we have a buy on, have been doing pretty well on this raised expectations of tightening monetary policy. I think one final message is the tech stocks, which have been derating due to fears of rising rates impacting valuations. We have a lot of buys on tech stocks in RE Vitrox. We would definitely say, don't throw the baby out with the bathwater. The biggest deratings for tech stocks, if you look even regionally, like Bukalapak, Goto, have been the more sort of innovative or speculative business models where, you're not really seeing profits yet. The Malaysian tech stocks, on the other hand, are very much in the firmly profitable basket, very good returns on capital, tested management, globally competitive. So, when the dust settles, we feel that there will be a lot of bargains in this sector. So we would definitely look to accumulate on weakness.
Since the ringgit has been weakening over the past week, are there sectors that are a bit more vulnerable, or stocks that are vulnerable to a weaker ringgit, and which names might benefit?
Yeah, so generally the stocks that do well are the exporters and the ones that sell in US dollars but have cost basis in ringgit. And really that's the bulk of the tech sector as well as the gloves space. I think gloves fundamentally a very tough story right now, so I don't think the exchange rate story will help them very much. But definitely in the tech space, for some of the stocks we like a lot, like Vitrox and Great Tech in particular, the sensitivity or the positive leverage into a weakening ringgit is very high. You also have other exporters which are less obvious, like Petronas Chemicals, export in US dollars. Plantation companies, their commodities are in US dollars. A lot of their costs are in ringgit. So those is where you will look for winners: plantations, petrochemicals, tech, and other exporters like gloves. Losers will be the big importers, and that's fewer and far between. So stocks like Tenaga, where you import a lot of coal, Astro, where you have a lot of content costs in US dollars, and the auto space, where you have a lot of component costs in US dollars, would be the ones where you would see some headwinds to earnings.
Okay, thanks, Anand. Mun Yi, for the ASEAN-X, you looked at the likelihood of defaults in the Malaysian corporate bond market in a rising interest rate environment. So what are your key conclusions? Are credit spreads too low and not sufficiently pricing in the higher default rates?
Hi, yes. So when we look at past default trends during the rate normalization cycles, we did notice a slight increase of defaults after rate hikes. But when we drill down to individual credit, the defaults cannot directly be attributed to interest rate increases, and rather it was mainly due to firm-specific or corporate governance issues. Looking at the Malaysia corporate bond rating universe, the rating migration had a negative bias in 2021. So what this means is that there were more downgrades and outlook decreases versus upgrades and outlook increases last year. And the rating migration is still negative bias with more downside rating actions in the first quarter of 2022. In short, the corporate bond rating universe is not out of the woods, as there are still currently 34 ratings on negative outlooks versus just 7 positive ones. So credit spreads have tightened this year, mainly due to the surge in MGS yields. And this may not fully reflect the credit risk in the market, as I mentioned, the negative rating migration trend, as well as risk of defaults. There has already been one default in April, which was Server Dynamic. But this is not alarming, as historically in most years over the past decade, the Malaysia corporate bond market generally sees 1 to 2 defaults a year. Nonetheless, we still think credit spreads are too tight. Spreads are currently near historical lows, and the last time it was at these levels was in 2019. That was when global central banks, including Bank Negara, eased monetary policies, and their dovish tone drove MGS yields down. The environment this time is very different, with MGS yields surging upwards amid the UST sell-off. The economy is recovering, and global central banks are tightening monetary policies. So we see a risk of credit spread widening if either PDS yields play catch up to MGS or a reversal of hawkish ringgit rates, but spreads are likely to remain below historical mean given ample liquidity underpinning demand.
So Mun Yi, which sectors and companies are vulnerable and could see negative credit ratings downgrades in the next 12 to 18 months?
Right, so ratings on negative outlook denote a likelihood of a possible downgrade in the next 12 to 18 months. So out of the 34 negative outlooks currently, 18 are in the lower rating bands of single A and below, which indicate weaker credit quality. By sector, these negative outlooks are mostly concentrated in the infrastructure and utilities, as well as the property and REIT sectors. Some of these names include Alpha Circle, Menara ABS, Imperfin, Senai Desaru Expressway, Segi Astana, Kappa Energy, and Tropicana Corporation.
Okay, thanks, Mun Yi. We'll go through a quick sweep of the property sector. Let's move into Thailand for Vanida. Vanida, your title, Before the Storm, paints a gloomy picture of the Thai property sector. Isn't the reopening and recovery helping? And what's dampening the sentiment?
Good morning. Last month, we downgraded Thai property sector to neutral from positive. The main reason is the deterioration of macro outlook, which I think will impact sales of big ticket items like property. For demand side, a downward revision of GDP growth forecast and rising cost of living will dent property sales. Escalation of construction material, energy, labor costs will also hit margins. In our view, developers' guidance seems hard to achieve if the tension prolongs. However, the pre-sale for the first quarter have yet to feel the pinch. They still grew by modestly at the mid-teen rate. Pre-sales of the 5 leading developers under our coverage were better than industry peers, thanks to the strong performance of AP and Supalai, whose first quarter pre-sale rose 63% year-on-year and 22% year-on-year respectively. As we strip out pre-sale of both, combined pre-sale from other developers slipped 3% for both landed property and condominium. The worst performer include LPN and Priksa, developers of low-income group. Nonetheless, many developers share the same view that pre-sale for the Jan and February were solid, but momentum is softening in March, and such trend should continue into April, which is generally a low season with a long Songkran holiday. According to the original plan, value of new launches this year should peak during the second and the third quarter. However, downside risk is a potential delay of new projects amid sluggish macro outlook and weak CCI, Consumer Confidence Index, and developer sentiment to their 6-month low. For the stock pick, our picks, we still favor Land and House LH and QH, who should see a recovery in their performance and earning from low base during the COVID outbreak. Both have non-residential business such as hotel, mall, financial service under the group operation, which should help to drive earning to a double-digit growth rate. LH is our top pick given good growth in every business plus healthy dividend yield. AP and Supalai, though show the strong first quarter pre-sale growth, we rate them as whole because we see that they are entering maturity stage with a less than 5% earning growth moving forward. And since their guidance this year in terms of pre-sale and new launch is aggressive compared to peers, we see that they may be sensitive to a weakening of the macro outlook. We rate Fraser Property and Priksa as sale. Both are developers specialized in the mid to low end segment. Year to date, pre-sale remains sluggish.
Okay, thanks, Vanida. Thank you, Vanida.
Thank you.
Okay. Sevi, the Philippine property market seems to be improving and correlated with the reopening and recovery in mobility. So do you think this recovery can be sustained, and what are the headwinds?
Yeah, good morning, everyone. I think on the recovery, so I'll answer that in 2 parts. On the recovery of foot traffic, we're seeing a sustained recovery of foot traffic ever since the dissipation of the Omicron surge. We've seen mobility levels average above pre-pandemic levels. Grocery mobility, for example, is 150% of pre-pandemic levels. Traffic congestion is at 140% of pre-pandemic levels. There's some skew because we're seeing heightened activity due to the campaign sorties. So I think after the elections are over in the first week of May, we will see, a more sustained, steady state of as far as mobility levels go. The other side to this is spending. So while foot traffic has recovered, spending is still fragile, or spending has a more protracted recovery path. So I think that what needs to be sustained on the foot traffic, I think vaccinations have to catch up in the provincial areas. While Metro Manila vaccination is okay, the vaccination per capita in the provincial areas still has to catch up. On the spending, I think it's up to the next administration to, I guess, have a, I don't know if they'll present a stimulus package or an economic recovery package to be able to accelerate the recovery momentum as far as spending is concerned.
Great, thanks, Sevi. So Jigar, congrats on a comprehensive 122-page big sector report on the regional utilities. You are turning more bullish because of the large-scale shift to renewables, replacing fossil fuel. Can you talk through your bullish thesis on this sector?
Yeah, hi, thanks. So essentially, the reason to get bullish about the renewables is multiple reasons, but the immediate trigger that came from this Russia-Ukraine geopolitical tension and the substantial increase in the energy prices globally. The kind of energy inflation that is now being experienced by many of the economies in ASEAN plus India would push this shift to renewables, which was anyway getting inevitable. We have used some of the climate scenarios as provided by IPCC, IEA, and a few others, which point out that we actually have very little window now to save the world from going to more than 2 degree centigrade increase in temperature by 2100. And we are about to use all our carbon budget. And therefore, the shift to renewables is inevitable. But if we look at the share of renewable today, it is about 9-10% in the overall energy basket and about 15% in the electricity. So what we believe is that the electricity as a percentage of the total energy is about 19% today, which is expected to get to about 50% by 2050. Because when you look at the transportation, buildings, and industry, the three major users of energy, unless electricity use moves up, we cannot decarbonize and we cannot use clean energy, and therefore we cannot meet the target. So this is something which was anyway underway. It has got a push because of the geopolitical tensions and the subsequent sharp rise in the energy prices. The other important point to note is that today, in most of the countries, the prices of renewable, that is solar plus wind-based energy, are less than the fossil fuel-based energy. And in fact, you can do long-term contracts on renewable energy, which is not possible in case of the fossil fuel energy. So we think that there is going to be a very rapid transition now because of this purpose. In fact, countries like Germany and others in Europe have already talked about it to advance their timeline. I think as the availability of finance becomes more easy in the Asian countries, that would also take place. And we have seen transactions pertaining to that very recently in Tata Power in India, where BlackRock and Mubadala have invested. And there are other companies who have got green bonds issued recently. There is a massive investment happening in green hydrogen in India and elsewhere also, as I can see. So we feel there's going to be a very rapid transition, and there is a very strong investment thesis here. And it can only be compared to the tech revolution, which took place in the late 80s and is still continuing. But obviously, at that point of time, people would not have thought that it can become so big. So this is probably going to be at the risk of sounding very over optimistic. I would say that this is a comparable opportunity to that, and that shift is going to be a kind of once in a millennium type of shift.
So Jigar, you highlighted that the ESG risk ratings matter and have a direct bearing on valuations. But for most of ASEAN and India companies, the ESG ratings are high to severe risk. So why are the ESG ratings so much more worse than the US and European companies, and what needs to change for this to...
That is, yes, I think that's a very good question. The point here is that the transition of the companies in Europe and US started much earlier. So the likes of Orsted or Iberdrola or some of the Italian companies, they all started probably about 8 or 10 years ago in this journey of moving from fossil fuel to renewable energy. And today they are like more than 50, 60, 70% towards the renewable energy. And that's what is helping them. So their emissions are down, and their carbon costs have come down. And they are getting funding at a cheaper rate. So their risk ratings are medium to low. In fact, the ASEAN plus India utilities have already started on this journey, and going by their qualitative parameters, their policies and the targets which they have laid out, it appears that they are also heading in the same direction. In fact, the likes of Tenaga and Tata Power have already talked about going net zero by between 2040 and 2050, which would mean a rapid decarbonization of their portfolio. And it would also be very clear that their risk ratings would improve from the current high to severe to a medium to low over a period of 5 years or 10 years. Because in this, ESG risk ratings, I think we'll have to look at a block of 5 years. But going by their commitments and targets, they are already moving in that direction.
So lastly, just what are the top picks in ASEAN and India to play this theme in the regional utility sector?
So we have covered 9 companies over here, 4 from Philippines, 1 from India, Malaysia, Thailand, and Singapore each, of which 4 are rated. But 1 on Tenaga is hold, and the 3 that is Tata Power, Bigrim in Thailand, and Aboitiz Power in Philippines, they are the buy. And each one of them have a fairly compelling transition strategy. So that's what makes us quite positive on, and 20 to 27% upside on these names.
Thank you, Jigar.
Thank you.
Just before we wrap it up, just to note that Invest ASEAN dates has been set for 8 to 9 of June, two-day event. So please block those dates. Thank you. Have a good week ahead.
That was Chua Hak with our analysts on their Monday call. Find out more from your trading rep or check out market insights on the Maybank Trade app. Also follow us on Spotify and Apple Podcasts. I'm Noelle Lim on ASEAN Speaks by Maybank Investment Banking Group.